Hello, everyone. Welcome to Money Minutes. I'm your host, Zak Gardezy. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So here on Money Minutes, I share with you some of the latest market headlines and my outlook for what's ahead. And so for this week's episode, I'll talk about what's on most investors' minds, which is the market and why it's off to a bad start for 2025. I'll share my thoughts as to what are some of the factors behind this and my outlook for the weeks and months ahead. And I'll share my insights for conversations that I'm having with clients as it relates to their overall portfolios. And if you're wondering why I'm wearing an Ohio State quarter zip, I don't really have a good answer for you. I found this in my closet, and they're playing on January 20th for the college football championship. And so I guess for the sake of this episode, I hope Ohio State wins the game. So let's get started. So as I mentioned earlier, the market is flashing some warning signs. And as I mentioned earlier, it's a bit like the market's having a temper tantrum. And this really started in December. So if we take a step back, the Federal Reserve in their FOMC, which is the Federal Open Market Committee meeting, the chairman of the Federal Reserve, Jerome Powell, came out and shared his views and the Federal Reserve's views on 2025. They made a decision to cut interest rates in December, but also talked about, their summary of economic projections and took some questions from those in the room around the changes in the summary of economic projections from December to the previous one that was released in September. It's a quarterly report where Fed officials basically share what their projections are for the year ahead, basically, in terms of inflation, GDP growth, unemployment, and other key pieces of data that the Federal Reserve likes to keep top of mind. Now, the big deal here is that in September, the Federal Reserve projected that by the end of 2025, inflation would be at 2.1%, which is basically at their 2% long-run target, and some would even say that's a victory for the Federal Reserve. There was a lot of euphoria based on this, and also based on the fact that at the time, the Federal Reserve was projecting 4 interest rate cuts for 2025. Now, if we also take a step back to September, that's when we got a much bigger than expected rate cut, 50 basis points in September. That was a surprise, a good surprise from the Federal Reserve. And the market continued to ride on this euphoria with the summary of economic projections. There was good things happening with artificial intelligence. The election was coming up. The fate of the election wasn't known yet, but there was some optimism growing in the Trump camp around their odds of getting reelected, which then brings tax cuts and deregulation, other typically positive things for the overall stock market and economy. Now, as the months went on, we got to November. The election happened. Thankfully, it went through without much of a hitch. There was a lot of concerns around what would happen with the election relative to the previous one. And then as the year drew to a close, again, pretty normal, mellow year as the year ended. But then came the Fed's meeting in December, where basically the chairman came out and said, and along with other Fed officials, hey, look, we've revised our estimates for next year. We no longer expect 2.1% inflation by the end of 2025. We're now expecting 2.5%. Now, that may seem like a small difference mathematically, but in terms of the Federal Reserve, that's a huge difference. Also, unemployment was projected to be higher than what it was in September. So this is another negative projection. And really, when they asked the Federal Reserve, why is that? The chairman basically said some members of the Fed are taking into consideration the incoming president's political policy decisions, especially around trade and other matters, and how that would impact inflation. Now, this changed the expectations around interest rate cuts from 4 down to 2 cuts in 2025. Now, this is a huge deal because interest rate cuts, basically the market uses these projections to price in things in the market. For example, the 10-year Treasury moves, right? This is basically a forward-looking indicator. Where do we think interest rates are headed? If we think interest rates are headed down, you start to see the 10-year Treasury come down. When the 10-year Treasury comes down, typically mortgage rates come down and typically bond investments that many investors own today go up in value. There's a bit of an inverse relationship there. Also, as interest rates come down, the stock market typically does well because borrowing costs are lower, and this is typically a good thing for companies. There are a lot of other factors involved with interest rates. I'm really simplifying it here, but the overall 30,000-foot view of it is lower interest rates are good for the market and the economy, and higher interest rates are a bad thing. So if we are now revising our expectations from 4 cuts in 2025 down to 2, this is bad news for the overall market. And so that shocked the market, frankly, in December, and a lot of investors and analysts. And then the market trucked along. We got to January. Then we got 2 jobs reports. One was for the month of December. So this was released in January. It tells us about new job additions in December. This came in much hotter than expected. So in December, 256,000 jobs were added when 153,000 were expected. The December report, which again released in January, also showed lower unemployment, and hourly wages increased for 2024 by 3.9%. This tells us that employers are paying higher wages to attract talent. Again, this is an inflationary sign. Additionally, the JOLTS report was released in January. This report highlights key labor market data as well, notably job openings. So this data, which was released again in January, reflects for the month of November, and it showed 8.09 million new job openings when 7.7 million were expected. So more than expected job openings are also an inflationary signal, and this shows that businesses have a need to hire more, and as I noted earlier, they're willing to pay more for labor, which ultimately leads to more wage inflation and overall inflation. Now, the key question is, will this lead to more overall inflation, right? And we'll find out very soon because the Consumer Price Index report is going to be released on January 15th, likely when many of you are watching this video. And then later in the month, we'll also see the Personal Consumption Expenditures Report, PCE. This is the Fed's preferred gauge for inflation. That will be released at the end of the month. And also near the end of the month, the Federal Reserve is meeting again for their FOMC meeting. So we'll hear directly from the Fed chairman in terms of, again, his thoughts on the economy, where we're headed in 2025, and what Fed officials are thinking. The expectation right now is that the Federal Reserve will pause and not cut interest rates in January. But the concern is, what will the Fed chairman say? Will he come out and be even more negative than they were in December? And that, of course, won't be taken well by the market. Or did they realize, hey, maybe we were a little too critical in December and let's soften up a little bit? Who knows? At this point, the Federal Reserve kind of started this downwards movement and negativity. And now some of the data that we're getting is being hyper analyzed by analysts and the overall market. Now, I'll be interested to see what happens with CPI and PCE and all the other reports that we'll get throughout the month, as that may shift expectations. And the key here is the economic data is very fluid and it's changing things rapidly. I mean, the Federal Reserve in a few months could even go back to where they were in September, where things were a lot more rosy and optimistic. And so my overall view here, my outlook over the next few months really boils down to, I personally think that the Federal Reserve may have made too harsh of an adjustment on the summary of economic projections. And I think, frankly, that we'll see economic data smoothen out over the course of the year. We still have elevated interest rates, which typically slows down the economy, typically slows down the labor market. This was a concern in the back half of 2024, and for some reason it's not anymore, but it's still happening. Although we have had some hotter than expected jobs reports, I think that we'll find out that those are a bit seasonal and the economy is still slowing down. And so we'll see, but if that's the case, again, this points to an opportunity, I think maybe a buying opportunity in the market where economic data will improve, Fed expectations will improve. And also another big missing piece here is the incoming administration. January 20th is Inauguration Day. the new president will take over, and then we'll see, are these policies that were touted on the campaign trail going to actually take shape? For example, will the Congress give the president these massive tax cuts that he's promised? Will the Congress and the executive office work together to place all of these tariffs that they've talked about on these countries? And how will this affect our relationships with, for example, China and Canada and other key trade partners? What inflationary impacts will those have? And so, how about the mass deportation strategies and all those potential job losses and the cost of doing that? And what are all the answers to these questions? And it makes sense why the Federal Reserve has their concerns, but we will find out soon if much of that was campaign rhetoric, which it typically is, or will these policies actually take place and what their impacts will be. So my overall view is to remain invested. If you're holding on to large amounts of cash, it really depends on what stage of life you're in. If you're in the pre-retirement, retirement stage, like most of my high net worth clients, then you should stay put where you're at and be very cautious in where you invest and how you invest. If you're more of a higher risk investor, maybe in a different stage of life where you can take on these kinds of risks, then speak with a professional and talk about what areas that you might find that you could invest in. And so this concludes this week's episode of Money Minutes. If you would like to have your portfolio reviewed, please don't hesitate to reach out. Thank you so much for tuning in.